For the last 50 years, a single unbreakable rule has governed the global economy. Oil is priced in US dollars. This system, secretly forged in 1974 between the United States and Saudi Arabia, is the very bedrock of the dollar's dominance. It's why every nation needs dollars, why America can export its inflation, and why the currency in your pocket has value. But what happens when the architect of that system starts to see cracks in the foundation? What happens when the keeper of the world S's most vital commodity looks at the depreciating paper it receives and decides it wants something else, something tangible, finite, and absolutely critical to its own future? We are on the verge of that decision. The next great geopolitical shock won't be Saudi Arabia abandoning the dollar for the Chinese yuan or the euro. No, it will be something far subtler, smarter, and infinitely more devastating for the modern financial system. It will be Saudi Arabia announcing that for a portion of its oil, particularly to its strategic partners in the East, it will now accept payment in physical silver. This isn't a fantasy. It's a logical, almost inevitable next step, born from economic necessity, national strategy, and a fundamental shift in what constitutes real wealth. This is the blueprint for the Petrosilver agreement. To understand why this is not only possible but probable, you have to understand why the petrodollar is now a liability for the Saudis. The original deal was simple. Saudi Arabia prices its oil exclusively in dollars and recycles its profits into U.S. Treasury bonds and weapons contracts. In return, the U.S. guarantees Saudi security. It was a perfect, closed loop. But today, that loop is broken. The United States is no longer the world's dominant oil importer. It's now a competitor. Saudi Arabia's primary growth market is Asia, especially China and India, who are actively building systems to bypass the dollar. The U.S. security guarantee is looking more and more fickle as Middle East policies shift with each new administration. Most critically, the Saudis are being paid in a currency the Federal Reserve is actively devaluing through trillions in deficit spending. Their vast holdings of U.S. Treasury bonds are losing real purchasing power every single day. They are trading a finite, depleting resource, their precious oil, for an infinite, depreciating liability, U.S. dollar debt. This is a terrible long-term trade, and the kingdom knows it. Their Vision 2030 plan, a radical economic transformation, is their public admission that the oil for dollars model has an expiration date. They have to convert their oil wealth into something that will last: sovereign wealth, cutting-edge technology, and hard asset security. This is where silver enters the equation, not as some nostalgic relic, but as a strategic, dual-use asset for the 21st century. Saudi Arabia isn't looking to just collect shiny metals. It is building the most ambitious national infrastructure project in human history, a post-oil economy from the ground up. At the heart of this vision is the NEOM megacity and a pledge to become a global leader in renewable energy. The cornerstone technology of renewable energy is solar power, and the cornerstone material of high-efficiency solar panels is silver. Saudi Arabia's plans require gigawatts upon gigawatts of solar capacity. By 2030, they want to generate half their power from renewables. This requires a secure domestic supply of a critical material that they do not mine themselves in any significant quantity. They face the exact same vulnerability as Europe or the US, a total dependence on a fragile global supply chain for a non-substitutable industrial metal. So what if they could use their one remaining massive point of leverage, their oil, to solve this vulnerability permanently? This is the strategic calculus. By accepting silver for oil, Saudi Arabia achieves several critical objectives all at once. First, it bypasses the dollar for a portion of its trade, diversifying away from American fiscal risk. Second, it acquires a critical industrial commodity essential for its own energy transition directly, without having to fight for it on the open market. And third, it stockpiles a sovereign monetary asset that is valued everywhere, carries zero counterparty risk, and acts as a hedge against the very currency devaluation that is threatening its dollar reserves. This wouldn't be a big public declaration. It would be a quiet bilateral protocol. Imagine a state visit between Saudi and Chinese officials. A joint memorandum is signed: cooperation on energy security and strategic resource stability. The details are vague, but the essence is a long-term supply contract. China agrees to buy a set volume of Saudi oil for the next decade. A percentage of that payment, say 10 or 15%, will be settled not in yuan, but in physical silver bullion, delivered directly to a brand new high-security vault in Riyadh. The silver would be sourced from China's vast refining capacity, possibly from mines in Peru or Mexico that Chinese companies now control. This achieves China's goal of locking in its energy supplies while giving Saudi Arabia exactly what it needs: a direct pipeline of strategic material. The transaction is invisible to the COMEX or the LBMA. It is a state-to-state, physical-for-physical swap. This is barter on a civilizational scale. The immediate global shockwave wouldn't even be in the oil markets. The price of oil might barely flinch. The earthquake would resonate through the monetary and commodities markets. It would shatter a psychological barrier that has stood for half a century. That oil, the lifeblood of industrial civilization, must be priced in fiat currency. If oil can be traded directly for silver, then silver is no longer just a commodity. It is reestablished as a settlement medium between sovereign nations. Its value proposition changes overnight from industrial metal to monetary energy exchange unit. The immediate effect would be a frantic global reassessment of silver stockpiles. Every nation that imports energy would be forced to ask, do we have enough strategic silver reserves to secure our own energy deals if this becomes a trend? The scramble would not be led by hedge funds, but by finance ministers and central bank governors. Suddenly, the demand for silver would have a steep, vertical, state-driven component that hasn't existed since the days of bimetallic coinage. Furthermore, this move would expose the fatal weakness in the paper silver market. The COMEX and LBMA trade hundreds of millions of paper ounces that don't actually exist. The Saudi-China deal might only involve a few tens of millions of physical ounces a year, but the precedent, the perception, is what matters. If a primary oil producer values physical silver enough to accept it as payment, then the legitimacy of unbacked paper claims on that same metal evaporates. The premium for real, deliverable silver would permanently detach from the paper price. Why would the Saudis accept a paper ETF share or a futures contract when they need the actual metal to build their solar farms? They wouldn't. This would accelerate the great divorce between the physical and paper markets, draining the last bit of credibility from the fractional reserve trading system. The domino effect would be swift. Other commodity-rich nations would see a new blueprint. Russia, already cut off from the dollar system, might start accepting gold and silver for its oil, gas, and grain. African nations with cobalt or copper might seek similar hard asset deals. The barterization of global trade would begin in earnest, with precious metals as the essential clearing agents. This doesn't mean the dollar disappears overnight. It means its dominance is fractured. It becomes just one option among several, and its value is now directly compared to and eroded by the systemic demand for tangible settlement assets. For the individual, the Petrosilver scenario is a decisive end to the debate about silver's role. It stops being a speculative play and becomes a strategic reality. The metal in your possession is no longer just a hedge against inflation. It is a share in the emergent asset-backed settlement layer of the new global economy. It is a claim on the future of energy and trade itself. The move by Saudi Arabia would not be an act of monetary idealism. It would be a cold, pragmatic act of national survival, trading the wealth of its past, its oil, for the essential material of its future, its silver energy infrastructure. When the keeper of the world's oil wealth decides that the best thing to trade its oil for is not dollars, not bonds, not even gold alone, but the very metal that harvests the sun, you will know the old system is finished. They will not announce the end of the petrodollar with a speech. They will enact it with a vault receipt for 10,000 silver bars. The signal will not be a headline. It will be the silent, weighty clink of one form of real energy being exchanged for the foundation of the next. Thanks for watching. If you found this analysis valuable, be sure to like this video and subscribe to the channel for more insights into the shifting global landscape.